Have you ever wondered how regulators decide if a giant company merger is a good thing or a bad thing for the rest of us? Well, it is definitely not guesswork. They use a special set of tools, kind of like an investigator's kit, to look at an industry's DNA. So let's open up this toolkit and see exactly how it works.
Our investigation kicks off right here with a real-world headline. T-Mobile and Sprint, two absolute giants in the wireless world, merged in a deal worth a staggering $26 billion. Now, this wasn't just some simple business deal. This was an event that shook the entire market.
And that brings us to the big question, the mystery at the heart of this. Why on earth did a deal this big face intense challenges from both federal and state agencies for almost 2 full years? What were they so worried about? You know, the answer lies in how they analyze the very structure of an industry.
To crack this case, we really need to start thinking like an economist. We're going to open up their toolkit and look at the actual instruments they use to measure a market, to understand how companies behave, and most importantly, to predict the impact of a massive change like this merger.
Okay, first things first. Let's get a clear picture of the crime scene, so to speak, before the merger. The U.S. wireless market was pretty much dominated by 4 major players. You had the heavyweights, AT&T and Verizon, and then you had T-Mobile and Sprint as these significant but, smaller competitors. This is the exact landscape regulators were staring at.
So, the very first tools an analyst pulls out are designed to answer a pretty simple question. Just how crowded is this market, right? Is it like a bustling street full of little shops, or is it more like a quiet town with just a couple of giant superstores? This whole idea is called measuring market concentration. The most straightforward tool is the 4-firm concentration ratio, or C4 for short. And it is exactly what it sounds like. You just add up the market shares of the 4 biggest companies. So if we look at our wireless example, AT&T, Verizon, T-Mobile, and Sprint controlled, well, basically the entire market. A C4 ratio of 98%. It's a very quick, if a little blunt, snapshot of who's in charge. But you know, for a more precise measurement, regulators turn to something called the Herfindahl-Hirschman Index, or HHI. Now, the secret sauce here is that it squares each firm's market share before adding them up. So why does that matter? Well, because squaring the numbers gives way more weight to the giants, which paints a much clearer picture of who truly holds the power in a market.
And here it is, the formula itself. Now, don't let the symbols freak you out. All this is really saying is, take the market share of each firm, that's the W, square it, add them all up, that's what that funky E-looking sigma symbol means, and then just multiply the whole thing by 10,000 to get a nice clean number. This is the math that underpins pretty much all modern antitrust analysis.
Let's make this real with a quick example. Imagine an industry with just 3 firms. One has 60% of the market, and the other 2 have 20% each. So we square each of those shares, which you can see there in that last column. We add them up to get 0.44, multiply by 10,000, and voila, the HHI is 4,400. And just remember, a higher number means a more concentrated, less competitive market.
But look, concentration is really just one piece of the puzzle. To truly understand an industry, we have to dig deeper, to look at its fundamental DNA. So what are the other core components that define how a market actually works?
Well, an analyst's checklist goes way deeper. We've talked about the number and size of firms, but they also look at the technology involved, the customer demand, and this one is a huge deal. How hard is it for a new company to even get into the game and start competing? Technology is a massive driver of an industry's structure. Think about it. Is the industry labor-intensive, like a restaurant, where most of your costs are your staff? Or is it capital-intensive, like building cars, or, say, a national 5G network, where you need billions of dollars in equipment before you even sell a single thing? This one factor shapes the entire competitive landscape.
And this brings us to a really critical concept, barriers to entry. These are basically the moats around the castle that protect the companies already inside. It could be the massive cost of building a new factory, or owning a crucial patent that nobody else can use, or just the fact that the existing companies are so huge they can make things way more cheaply. The higher those barriers, the less competition you're likely to see.
So here's the key takeaway. This underlying structure that we've been talking about, it directly influences how companies actually behave out in the real world. Their conduct, how they set prices, how much they advertise, their decisions to merge, it's all a direct response to the market environment they live in.
Okay, so how do we measure that behavior? Well, one really powerful tool is the Lerner Index. It's a pretty clever way to measure a firm's market power just by looking at its pricing. It asks a simple question. How big is the markup of a product's price over its marginal cost, which is just the cost to produce one more unit of that thing?
So let's make that real. Imagine it costs an airline $200 in fuel and crew time for you to get on a flight. That's the marginal cost, but they charge you $300 for the ticket. The Lerner Index shows us that the price is 1.5 times the marginal cost. This little number gives economists a tangible way to measure that airline's pricing power.
Now we can get back to the actual conduct that started this whole thing, mergers. The most common type is a horizontal merger, and that is exactly what we saw with T-Mobile and Sprint. It's when two direct competitors who make very similar products decide to become one company.
Then you have what are called vertical mergers. So instead of buying a competitor, a company buys a different part of its own production line. Think of a car maker buying a tire company. The goal here isn't to kill competition, it's to control their supply chain and hopefully cut costs.
And the last type is a conglomerate merger. And this is where things can get a little wild. It's when two totally unrelated companies join forces, like a software company buying a fast food chain. The logic here isn't about market control at all. It's about diversifying the business and spreading out financial risk.
So how do all these different pieces fit together? All these tools we've talked about, concentration, barriers to entry, pricing behavior, they're all part of a grand theory called the structure-conduct-performance paradigm. Just think of it as the master blueprint for analyzing any industry out there. The traditional view is pretty simple. It's a one-way street. The structure of the market dictates the conduct of the firms inside it, and that conduct, in turn, leads to the final performance of the industry, things like profits, efficiency, and just overall benefit to society. Structure causes conduct, which causes performance. Simple, right?
Well, modern economists have added a crucial twist. It's not always a one-way street. A firm's conduct, like, say, a massive R&D push that creates a new game-changing patent, can actually change the market's entire structure. And a market's performance, like, enormous profits, can fund behavior that locks that structure in place. It's a feedback loop.
Ultimately, all of this analysis helps us put an industry into one of 4 basic buckets. You've got perfect competition on one end, with tons of firms and zero pricing power, all the way over to a monopoly, with just one firm and a ton of power. The wireless industry, with just a few huge firms, that falls squarely into the oligopoly category.
So now we get it. Now we understand why the T-Mobile and Sprint merger was put under the microscope for 2 solid years. Regulators use this very toolkit to measure the change in concentration, to evaluate the barriers to entry, and to predict the impact on our phone bills. But this leaves us with one final critical question. In an age of global tech platforms and sprawling digital ecosystems, is this classic toolkit built for a world of factories and phone lines still sharp enough for the job?